Equity Group's net profit dropped by 14.6% to 14.8 billion Kenyan shillings at the end of the third quarter from 17.3 billion Kenyan shillings that was posted in a similar period last year. The group also reported about a 30% growth in its loan book. The group managing director and CEO James Mwangi joined us earlier to dissect their performance.
We announced the result of Equity Group for the third quarter. They reflect a growth of 30% on loan book, 45% on deposits, but a 14% decline in profit after tax. But profit before provisions is up 30%. Essentially, the bank has taken a conservative approach, recognizing the uncertainty that COVID has placed in the operating environment, and increased provision 11-fold from 1.3 billion to 14.3 billion shillings.
Yes, now, James, when you look at the bank's loan book, as you said even earlier on, it grew by 30%, and this comes at a time when there is a risk aversion has increased due to the pandemic. What would you attribute this increase to?
This is a strategic decision that we made from the onset, that we'll observe the green offshoots in the new environment, and we'll direct credit there so that we can keep the rights of the economy on, and we can uphold livelihoods and lives within the communities we operate in. So we have pushed a lot of credit on PPE manufacturing companies, logistic companies, online businesses, and we have also seen a window in agro-processing and FMGs that are focused on what one would call inflation-proof sectors.
To run us through some of the reforms as well as the restructuring process that the bank had to go through in order to cushion itself from the effects of this pandemic.
From the very onset, we studied health pandemics that have occurred in the world over the last 1,200 years. And we realized that they always drag themselves. So we made an assessment that COVID-19 will be a challenge for the next 3 years. So we assessed all the sectors that were directly affected. Either they required a lot of mobility, they depended on global logistics, they depended on global trade, things like tourism, things like aviation, and we gave them a holiday, a repayment holiday of up to 3 years to coincide with when we expect the impact of COVID to have been managed. We assessed that will be about 45% of our entire customer base. I'm glad to say that 10% opted to continue training but paying under the old regime. So we only accommodated 35%. Out of 35%, another 25%, although they accepted the rescheduling of the loans, they maintained repayment on the old regime. So it's only about 26% of all the customers who took the accommodation are you fully utilizing. And it's for that reason that we have seen the support created resilience in the customers. It created a commitment to live to their obligations. And for that reason, that's why we have continued to push more money, because we have seen with good planning, businesses can survive under challenging environment.
Yeah, now also, when you say businesses can survive under challenging environment, some people saw it as a challenge, but then there are also other people who saw this pandemic as an opportunity. And they saw it as they could come and find solutions to certain gaps that it was presenting. What would you say were some of the positive side effects, and how has the bank managed to leverage and use this as an opportunity?
We felt that this is a crisis that we should not waste. And we saw the silver lining in the crisis. As a result, we adopted a two-pronged strategic approach, a defensive and an offensive. Along the defensive was to protect the customers, protect the staff as much as we could, and at the same time, protect the balance sheet of the bank. And that is why we went for provisions, went for credit enhancement guarantees of 400 million to ensure that the customers that will strain, that will not impact the balance sheet, but will be taken through the credit guarantee. We also took credit lines of 600 million to ensure liquidity is not impaired in the bank or on the balance sheet because of credit accommodation. That dealt with the defensive. On the offensive, we asked ourselves what opportunities, as the world economy reallocated resources to new sectors, where would we be playing? And that is why you have seen our credit grow by 30%, because there has been a significant reallocation of resources because life have to go on and the rest. And the last one is we saw the opportunity and ended up buying BCDC in DRC. And that has helped us now, a merger of Equity Bank Congo and BCDC will create the largest bank in DRC. And that has a contribution to the growth of our deposit by 45%. We have been enormously rewarded because that enabled us to accelerate the innovations in the digital bank. And as we speak, 98% of all our transactions are happening outside. And since we kept the customers busy with the credit, we have got them now to be acquainted to new digital banking. And in the process, the bank has moved from fixed cost channel to variable cost channel. And we have seen our cost income ratio decrease from 51% to 47%.
Now, James, do talk to us about the expansion plans into the Democratic Republic of Congo, the projections that you had, as well as the market response and the market demand that currently is there available.
6 years ago, we bought ProCredit, a German bank. And the last 6 years then has given us an opportunity to study that market very closely. What we have seen is an economy that is gradually improving, particularly from governance structures, strengthening its political structures. And hence, we saw that the biggest risk was being addressed. We have seen the resilience of the commodity prices for which DRC is known for. And lastly, we have understood that only 6% of the population is banked. So we saw a big opportunity when we compare DRC and South Africa and Kenya, who have 90% of the population banked. And so that window of increasing bank population, maybe 70, 80 in the next 10 years, we saw as the greatest opportunity. And that is why we have invested substantially in DRC, so that we can be an agent of that transformation and in the process build a resilient and sizable business.
On the fact that the bank's regional subsidiaries now contribute 40% of customers' deposits. What does this say about the group's growth within the region?
It means that Equity has stopped being a Kenyan bank to an Eastern and Central African regional bank. It has grown in balance sheets, almost touching $1 trillion Kenya shillings or $10 billion. So the capability of the bank, the strength of the bank has grown significantly. And this then places the bank in a position to be a significant catalyst in the development of this region, because intermediation will be necessary, funding will be necessary, and now we can play in bigger leagues than we have ever been playing, and leaders support governments to see the region transform.
Yeah, there is a significant customer shift, mainly brought about by the pandemic, towards using digital payment solutions. Just how has your customers been embracing actually digital payments? And talk to us about the investments that have been put in place towards achieving, streamlining the operations when you look at the digital sphere of the bank.
COVID has acted as a tailwind to our innovation sphere. It has helped particularly our customers to accept, to migrate to the digital platforms. The health protocols of preferably not being mobile, working from home, hard hygiene, social distancing, have meant that the banking hall is not the appropriate place for a customer to be. Public transport is not the best place to be. So we used this as an encouragement to the customers. And what we have seen is that internet and mobile banking is now taking up 87% of all our transactions, while another 15% of the transactions are happening on third-party infrastructure. That has delivered convenience that we have never seen before to the customer. They can do banking whatever time, wherever they are. So essentially, we have compressed both the distance and time as far as the rights of customers are concerned. And since digital payments is part of this solution, we have then enabled lifestyle better than ever before. People don't need to carry cash. They can they can complete their transactions through digital payment. But the biggest beneficiary has come to our staff, who have now moved from what typically would be manual transactions to really value addition banking services to our customers, thus enriching their jobs. We have also given them an opportunity to accept the flexibility of also working from home. And I'm happy to say 45% of our customers are now working from home.
Yeah, now just when we are looking around the financial sector in the country, we are witnessing layoffs in the banking sector due to digitization as well as the effects of the pandemic. What has been Equity's strategy towards this?
Equity has deliberately strategized moving to the digital space, because we have recognized that our competition is no longer the brick and mortar bank. The biggest competition is coming from technology companies, or what people call the big techs and their platforms. And it's scale and margin that make them very, very fierce competitors to the banking industry. So to really survive that competition, we have opted to digitize the bank. We have opted to create the bank as a platform where customers can onboard themselves. They can save, they can transact, and they can move money on their own. And essentially, then we have enabled them to self-serve. And in self-serving, then they can support their lifestyle and they can control money. What that means is that we have not only given them convenience, but we have given them control over their money. We have empowered them, and they are no longer dependent on a bank staff to do what they need to do. And they can have the privacy and confidentiality that they deserve, because nobody else gets to know how they manage their money. They are not dependent on a bank staff. We are now more of an enabler of a lifestyle.